Let's go to the fixed income quickly, shall we? And that's why Eronmosele Aziba, who is one of the investment analysts at Afrinvest, is sitting down here in the studio with me this morning. Let's take a quick look at the FMDQ or OTC market. Treasury bills, that's where you started from? Yes, that's good. Okay, 117, nearly 120 on Friday. Four most actively traded. And look at the yields, and that's what we're talking about. They're around the 13, 14.4, 13.8, and 14% for treasury bills that are maturing between now and September. Take note of the treasury bills maturing 6th of September 2018 at about 14.4%. So the longer looks like the level of the yield that you see on them. The shorter, then the more compressed the yields really were. That's the FMDQ OTC Securities Exchange. Move to the Naira bond, and we're looking at the DMO this week, whether it will make good the first Naira bond auction in 2018. That's about 17.3 billion, the secondary window on Friday. Okay, let's put Friday behind us. Or let's look at Friday last week and the first 2 weeks of this year with Eronmosele. Good morning. It's good to be here. Thank you very much for coming.
Thank you.
The stock market seems to be the one playing the king as we speak. So not a very bad way to start the year on the equity side of things.
Definitely not. We've seen the strong sentiment in the market from 2017 linger into 2018, and this has remained the major driver of activities in the market. It's also safe. We also take note of the fact that expectations for results of most of these companies is also largely positive, and we can say that this has also driven investors' sentiment. And back in the office, we decided to even carry out some sort of analysis comparing what we're seeing in the market now with prior years, if there has been any situation like this. And from our analysis, we noticed that back in 2012 and 2013 have been quite similar to 2017 and 2018 that we're starting now. If you recall, back in 2012, we saw a significant rally in the market as oil prices recovered.
Rally, yes, as well.
And then we saw when the Nigerian bonds were listed on the JP Morgan Emerging Markets Bond Index. So that also led to a lot of foreign inflows come back into the market, and this drove activities, and it was sustained in 2013 as well. So if you look at that with the situation of 2017 and 2018, we saw oil prices start to pick up in late 2016, and this was sustained in 2017. So as oil prices rallied, we saw significant interest in our market. And then with the launch of the investors and exporters FX window back in April, which led to a lot of foreign portfolio inflows that had hitherto avoided Nigerian market, started to return to the market, and we saw the significant rally that we had. And historically, January has also been a lightly positive month, say for the last 3 years, which have been quite peculiar with the issues of FX that we've had. But January has been largely positive. It's even termed the January effect. When you see this is more
than January effect. This is more than January effect.
Increased buying in the market.
Because the appetite really didn't slow down, technically speaking, all through the Christmas, all through the New Year, and looks like everybody just came back with this hunger under the belly, and they just wanted to keep pricing. And folks said, well, we're still, in terms of forward price earnings multiples, that we're still we're still a cheap market. And then, so you got your dollars, you can move in and mop up.
Yes, I mean, even from a foreign investor's point of view, if you consider the fact that the Naira was the value of Naira depreciated in prior year, so in dollar terms, it actually became cheaper for them to buy our assets. But the thing is, because of the issues that we had prior to the launch of the investors and exporters FX window, where we saw a lot of sell-offs across the market, we saw a lot of Nigerian stocks significantly undervalued in comparison to peers. So valuation that we're seeing in the market wasn't necessarily reflective of the fundamentals of these companies. So what we've started to see now is valuations have improved significantly. So now a lot of investors will be turning towards actual performance of these companies. And like I mentioned, the expectation is largely positive. So there's that chance that the rally will be sustained up until we start to see results.
And then we saw a massive rally in the fixed income of 2014, 2015, 2016, because as folks were dropping, they were selling out of equities portfolio, they were picking up fixed income in the run up to the 2015 general elections, and that continued because folks believe that, look, let's go long on this country, let's hold this. And the government was really in a very tight corner, borrowing massively, so yields just went, ooh.
Yes, I mean, with the weak appetite for equities, the one destination that funds started to go to was fixed income market, where you have reduced risk, and even yields at the market surged. So it was quite attractive for investors, with a lot of portfolio managers overweight on fixed income markets as opposed to equities. So that significant interest over the past 3 years has remained. And then in 2017, when we saw the pick up in sentiment for equities, we started to see some slight tilt, but a lot of it, portfolio managers still remain overweight on fixed income market, not just as overweight as it was in prior years.
When we say fixed income, what does it represent in an economy? Fixed income, basically treasury bills and bonds. What does it represent in an economy when we talk about that?
Well, basically, in terms of valuation of these instruments, so you can get a sense of what level of risk is, how investors view the country and the economy as a whole, in short term, medium term, and long term. What we saw, if you look at the yield curve last year and even the prior year, we saw that at the shorter end of the curve, yields were higher, which means investors were pricing in higher risks at the short end of the curve as opposed to the longer end of the curve. And what you have normally is the longer the tenor, the higher the risk should be. But what we saw in the market was a reversal of that situation.
So the risk pricing
was basically on the short end. But now we start to see some normalization in the market. Short-term interest rates have started to decline, with the CBN sort of guiding short-term rates lower at the end of last year, with the cessation of the Omo mop-ups that we had, which were at higher rates. So what we've seen is short-term interest rates have reduced significantly. Average T-bills rates currently stand at about between 13.5 to 14% thereabout, as opposed to what we had last year, where we had 18, 19, 20%.
I saw 20. I saw 20 last year. I'm sure you saw it. You see the numbers more than I do. But what exactly do investors want under the new regime that the Kemi Adeosun's team with the DMO and the central bank sort of come together, the guys who are guiding the financial services industry with the government, of course, handshaking them to look, we need to rebalance the treasury bills portfolio. We think it is too big. We think we need to squeeze a bit, we need to spruce it together a little bit, reduce our borrowing costs, and move on. What do you think investors would want under this new dispensation that is beginning to emerge? Of course, we expect a full unveiling of that in the current year.
Well, I think a lot of investors would still be waiting to get some sort of clarity as to how the markets would go. Like you mentioned, we saw significant borrowings rise significantly over the past year, with the need to finance the debt, the deficit side of the budget. So we saw a lot of even domestic borrowings also increase. But what we had closer to the end of the year was the announcement that they're going to tilt towards foreign borrowings in order to reduce the which were cheaper in comparison, in order to reduce the debt servicing burden. Because I think from in 2017 we had a debt servicing to revenue ratio of about 60% thereabout, which was quite worrisome.
We have about 2 minutes before we end this first part of our conversation, looking at the market's playbook in 2018. But what is my long end and where is the short end of the market? Do I play this new regime?
Well, basically, a lot of investors are still playing at the two ends of the market. So we have investors taking position in fixed income market, and in the equities on the other hand, in order to sort of balance the risk in the portfolio, there's still opportunities for gains in the equities market. So we have investors that's still there. But on the other hand, you have to hedge your exposure by taking position in the fixed income market. But we've started to see a lot of interest on the longer end of the curve, and we've seen a lot of investors take position there.
Okay, when we come back, Eronmosele Aziba will still be here to take us through Afrinvest new research report they're about to release. We hope that should be coming on the street. This week, we've seen a number of these reports coming through and everyone talking about it. So let's get us an insight into that. And if you are a local retail investor, we'll have some advice from Eronmosele when we return. I'm continuing the conversation around the fixed income market with Eronmosele Aziba, who is one of the investment analysts at Afrinvest. Thanks for being here. I'm sure, of course, you folks are looking at a report sometime next week. But first, let's continue. How do I read the Debt Management Office, the Central Bank, Playbook in the new year, looking at the auctions that we're expecting, which is monthly, of course, this week. Let's see whether the DMO will roll out January auction. We've seen the savings bond auction for January already, so we're looking for, and then the DMO is done. The central bank has started the new year aggressively mopping up. They've mopped up, central bank has mopped up almost $1 trillion already, while the stock market has gained $1 trillion. So I'm looking at how investors should be looking at all these government institutions, money managers, if you call them, both the DMO and the central bank, around my fixed income investing.
Well, like you mentioned, we've seen the CBN continue with its OMO mop-ups. But then again, it comes down to the individual investor. What sort of investment horizon are you looking towards? Do you have a more short-term to mid or longer-termed investment horizon? And investors will be taking note of rates at the market and yields, movement in yields. What end of the market would be best to enter? So for us, we would advise an active investment strategy, where, as opposed to what we have, where a lot of investors in fixed income market adopt a more passive investment strategy, just buy and hold till maturity. There will definitely be opportunities within the year for certain investors to
I've gotten a few folks who are off the street asking me whether she should do mark to market or should they hold short when they're looking at treasury bills, because they're looking at into yield and those. What's your advice for local retail investors here?
Well, like I mentioned, so for treasury bills, currently, because of the rates that you have in the market, holding to maturity won't necessarily be a bad thing, except you have other, but that doesn't take away from the fact that there are other investment opportunities out there. So for instance, investing in equities, where we've already seen significant gains, what we'd rather advise is having some sort of balance between both of them, investing in fixed income markets. If you want to do short term, then you can do treasury bills, and then you can also have equities just to back that up.
What do you think retail investors are looking for? Yes, everybody wants to make money, but again, there's something you're looking at in the economy. So the fundamentals of the economy itself, we have reports that there is a very strong uptrend in Nigeria's business confidence, for example. If you're taking that away from the last report of the Central Bank of Nigeria, whether it's the PMI or the third quarter 2017 GDP, that business confidence is actually increasing. Do you think Nigerians feel a lot more confident that the economy, the business environment is improving? The survey from the Central Bank of Q4 2017, I'm reading from what FBN Questa pushed out this morning, that the survey showed that Nigeria's business confidence is improving at 17.7%. Much better in positive reading, against a negative 29.0 reading in the corresponding period of 2016. So it looks like this confidence, is it something for me to consider whether I'm doing equities or I'm doing fixed income?
Well, yes, confidence in markets has significantly improved. I mean, even if you go back to PMI numbers, which gauges sentiment in manufacturing sector, since April, we've had consistent expansion. So yes, sentiment has significantly improved, and we can also see that in activities in the market. So in the sense that a lot of investors are starting to come back to the equities market, where risk is higher, but they're still willing to take that chance because they have a more positive outlook on the performance of the economy going forward, as opposed to what we had at the start of last year, where the outlook was rather negative. Oil prices still remain low, and we had this generally bearish mood around. But there's been a lot of optimism. So even looking at the macroeconomic indicators, we've seen the economy come out of a recession, GDP expanding in second quarter and third quarter, and we expect this to be sustained in fourth quarter. We saw inflation trend lower. We've seen external reserves surge to above $40 billion. So we've seen a lot of improvements. In the FX market, we've also seen stability. We've seen increased FX liquidity, which also makes it easier for business owners and operators to carry out their activities. So yes, confidence has improved. There's a generally positive sense out there, and these are also factors that we highlighted in our Outlook report that we'll be launching.
Yes, you're talking about the report. Give us some of the risks that are highlighted in your report. I don't have it yet. It's going to come out next week. I wish you give us a sneak preview. But it's okay. All right, we'll get a copy of that. But what do you consider? Are your risks outlook in tune with the rest of other research institutions or reports that are saying, look, pre-election is one, oil price is another one, a few apprehensions around insecurity, whatever part of the country you live in?
Well, we think one of the biggest risks, like you mentioned, is tied to political risk. So next year being an election year, as elections draw closer, we expect to see increased uncertainty in the markets as investors are trying to gauge what direction the economy will be going. Are we going to have, if there's some, are we going to have peaceful elections? Are we going to have peaceful transition or a continuation of the current administration? So that would be political risk. Will be another factor that investors will be looking at. Although we don't really expect this to come into play until the second half of 2018.
A quick one on that. Do you think, therefore, if investors are looking at these risks, would they be on the equity side? Would they be selling in May and go away?
Well, what we expect is that this rally would largely be sustained in the first half of 2018. For the second half of 2018, we expect to see a more cautious play from investors, especially for equities.
What about fixed income?
So interest in fixed income markets could increase. We might start to see some upward movement in yields as well, given the higher risk in the market. So we might have investors start to price this into their valuation, and that could be another factor that could come.
In terms of what we plan to do with rebalancing and readjusting our treasury bills portfolio, do you think we should do that in first half or second half?
Well, now that we've started to see lower yields at the market, now will probably be the best time to do that for the government, as we've still seen a lot of interest for these instruments. But like going back to your question about risks that we see for 2018, I think another one is the fact that the performance of the economy is still largely dependent on oil price movement. Although now the outlook on oil prices still remains largely positive, if in the event we start to have a downtrend in prices again, then we just might be back to where we were in 2014. Although reserves are a lot higher now, we've seen stability in the FX market, but oil still remains the major source of foreign receipts into the economy. So in the event that we have a reduction in that could potentially crystallize into a slowdown in activities in the economy.
Okay, let's go across market segmentation. If we go back into equities now, and I'm looking at, and even across our financial asset classes, whether I should go straight into equities, or I can do a mutual fund, or what's called a managed fund, or I should do, which include ETFs, for example, or ETP, or just go straight into a fixed income treasury bills, FGN bond, Naira bond.
Well, basically, again, it comes down to the sort of investor that you are. If as an investor, you know you won't really have time to be as active as you need to be in the market, then investing in a fund would definitely be one of the good options for you, like the Afrinvest Plutus Fund, for instance, where you have trained professional managers who are actually managing the fund and managing your investments for you and taking advantage of opportunities there in the market. Same, we also have equity funds that investors can subscribe to. And if you look at the performance of these funds in 2017, it was largely positive. And we believe this could potentially be sustained as well in 2018.
I'm looking at various economic segments in terms of segmentation. Industrial goods, construction, food and beverage, services industry, the banks, of course. So don't talk to me about the banks. No. We know almost everybody has the banks in his portfolio. So let's look at the banks. What should drive my sentiments if I'm doing equities and I say, look, I want to go into the equity side? What should be the fundamentals I'm looking for in the broader economy to make my pick?
Well, if you decide to leave out the banks from your analysis, which we expect to be the best performers,
that's your reading? That's what your research?
Yeah, we expect the banks to sustain. I mean, based on the issues that the generally tougher operating environment that we had over the past 2 years, the banks were still able to sustain an impressive performance, especially for the Tier 1 banks. So you have the likes of GT, Zenith, Access, UBA sustaining this during the time. So we expect, now that conditions have improved, we expect the performance to be sustained, and this would be the top pick in the markets in 2018. But we also note that there are still opportunities in other sectors. So for instance, the industrial goods sector, where you have the likes of Dangsem and WAPCO. Looking at the 2018 budget and the projection for capital expenditure, we also expect this to have a largely positive impact on that sector. And then going down to the consumer goods sector, with the improvements that we've seen in FX liquidity, which had weighed on their performance over the past 2 years, we expect to see an improvement in their own performance scorecards. And consumer spending has also improved, so this will also be largely positive for these companies. So our top pick remains the banking space, but we also see opportunities for investors in the industrial goods and consumer goods as well.
I'm going medium and small enterprises.
For
in equities.
In equities, well, yeah. I mean, we've seen a broad-based rally across the market. So as opposed to just having investments, going back to the banking space, as opposed to just having investments in the Tier 1 banks, we also saw a lot of the Tier 2 banks also appreciate significantly. We've seen the likes of Diamond, Fidelity, Sterling, Skybank as well. So we've seen a broad-based rally in the market.
Well, you mentioned Skybank there. It was just because I don't have the earnings from that bank
to look at, but we've still seen. So that just shows you the sentiment in the market. So Skybank hasn't released any results since 2015, but we still have investors buying into the stock. I mean, we won't recommend the stock for an investor for now, but we still have people buying into that.
And Wendo still doing massive volume, even though it's on technical suspension.
Exactly.
So it's generally just fire burning across the market. Everybody's been part of it. Everybody has shared that sentiment. What do you think would be a final take in terms of for local retail investors? What should they look at for, yes, the economy? How do you think the earnings for Q4 2017 and full year will be coming through in terms of the numbers and the expected cash, bonus, dividend, and with issues such as a 7-Up, Afelka buying out the Nigerian folks and say, look, we're paying 125 naira per share, and we'll have a nice handshake and say goodbye.
Well, I mean, for the 7-Up deal, for investors who already have taking position in the stock, it'll be good for them. I mean, the stock's price was about 70 naira thereabout, and the parent company has come up to say they're buying at this price. So that's significant upside for investors. But going back to the results, based on 9 months results that we've already seen, expectation is largely positive. And we've seen that reflected in trading activities in the market. That has also been a driver of the bullish sentiment that we've seen. And we're quite optimistic on results for companies in the market, banking, banks, industrial goods, even consumer goods. For oil and gas, sentiment towards the oil and gas stocks has been somewhat mixed in the sense that for the downstream players, so the likes of Total, 11,
Double One
PLC, sentiment has been somewhat weaker because of the issues that we've been having in the downstream sector and talks about.
So folks are pricing in those negative feelings about
pricing those in. But if you look at performance for 2017, the best performing oil and gas stocks were those in the upstream. Space, so Seplat and Oando.
I'm watching the numbers, but let's have it here. Let's let you out of here. Grab some work to do and see how the numbers come into play, and let us know when that report comes out next week.
Yes,
Eronmosele Aziba, one of the investment analyst team at Afrinvest Nigeria. Let's come back and talk a little bit something about supporting entrepreneurship here in Nigeria, and that goes to the base of the pyramid when you're talking about getting Nigeria moving. Let's see some of things being achieved.